So my first topic today is introduction to the world of technical analysis. Now, before we get into technical analysis, we need to understand which are the two basic schools of thought when we do analysis. The first one is fundamental analysis, second is technical analysis. Now, when we look at fundamental analysis, what does a fundamental analyst try to do? In simpler words, it is easier to say try to understand the intrinsic value of a company, look at the financial strength of the company, look at macroeconomic conditions, look at various other ratios, earnings, plus ROC, etc., etc., and then try to make a call on how much is the stock valued and eventually what does he think the value to be. Then we go to technical analysis. Now, this is a school of thought which is more statistical in terms of data, which is where the main data points are price, volumes, and then historical price and data charts. Now, what is a technical analyst trying to do is look at the past history of what has happened after a particular pattern formation and what has happened in different trends. And eventually something similar would play out in this case. Some of the basic terminologies which technical analysts use are supports, resistances, chart patterns, moving averages, etc. So why do prices fluctuate every millisecond or on a daily basis? Right? Ideally, in an ideal condition, the only time there is new information for the market is there is an AGM once in a year. There are quarterly announcements of results 4 times a year. There are 10 to 20 announcements the company makes regarding some changes or some announcements. Apart from that, you can pull out maximum of say 20 to 40 times where the prices should change. But what happens? Why do prices trade every millisecond? Either all of us are gamblers or it's a case of demand and supply. Now, if you think it's just the quality of the onion which decides the prices, you better not be cooking. Now, when we talk about technical analysis, it seems to be something which is new, but the reality is it is one of the oldest form of analysis. Now, if you go back, the first instances of speculation came way back in the 17th century in the Dutch markets. The next one was recording of prices in the Japanese rice markets done by a person back in the closer to the 17th century. And even today, we are using the same Japanese candlesticks. Then the next biggest contribution came from a person called Mr. Charles Dow. He was a journalist back in the early 19th century, talking about trends, speculation, and various things in his articles. Now, what is interesting is, if you look at the Dow Jones Index, it is something which was formed by Mr. Charles Dow and a collaborator, Mr. Jones. Now, this is how the index was formed. Even in India, the BSE Sensex, which we call about, was given a name by a technical analyst called Deepak Mohini. Otherwise, it was originally BSE Sensitive Index. So if we go back to the history, technical analysis and speculation has been going on for much longer. If you were to take the same thing for fundamental analysis, the big change happened in the 1930s after the crash of the 1929, the global economic depression. Up till that point of time, even in the US, it was not necessary for companies to give out quarterly results and volume numbers. It is only when the SEC came out in the 1934 where it became that data should be available for everyone. So, and that is where the whole legacy starts from Benjamin Graham. And originally, when you look at fundamental analysis in the past, it was about net asset values because of the scenario which we were in the 1930s. Now, let us take a common sense example. How does a technical analyst behave and a fundamental analyst behave? So, if you're in a new city and wanting to go out for dinner, how do you decide which place do you want to go? Or if you go for a shopping in a mall, how do you decide? So essentially, what will a fundamental guy do? He'll find out which is the best possible restaurant with the best rating, or he may look at which are the brands which are available. Say a form of armchair research would be looking at Zomato and saying, okay, this is a 4-star rated place, I'll go there. But essentially, if you want to do in-depth analysis, you want to go and find out who owns that restaurant, what is the history of that restaurant, what is the cuisine, and look at so many reviews, plus do your own scuttlebutt. But that is very difficult to do. Most of us with a camera also think we are a photographer. That is the way it works. Now, on the other side of a technical analyst, it's a very simple approach. You go to the mall, you look at which is the restaurant which gets the maximum people going in, right? That tells you this is ideally a place which is either trending or it is good. And generally that tends to work. So The approach for a technical analyst is to go with the crowd. Say maybe if I go to the same place 6 months later, there would be some other place which would be seeing the majority of the crowd. And what we've seen is this is how we used to approach back in the day and even today. So now when we go to technical analysis, it's not an exact science. So if it's not an exact science, there are some assumptions or principles which we work around. So the first one is history repeats itself. So basically there will be cycles of bull markets, bear markets. There will be scams which will be similar. Whether it is Madoff in the US, whether it is Harshad Mehta followed by Ketan Parikh, you'll see a lot of similarity. And that is what we tend to look out for in technical analysis. Second is averages discount everything. What it implies is in a normal trend, in good times, bad news will be digested much faster without a major impact, and vice versa in a bear market. The third principle is markets are supreme. Now, this is where technical analysis goes a little opposite to fundamental analysis, wherein we say Bhav Bhagwan che, and you accept the market prices. But as a fundamental analyst, you're saying the current market price is wrong. The fourth one is the primary trend cannot be manipulated. So when we are looking at technical analysis, you are looking at securities which are well owned and diversely owned. So if there is a lot of shareholders, it is very difficult to manipulate a company. Even if you can manipulate a company, you cannot manipulate the whole index or an index of 50 stocks or the whole market in India or any part of the world. So the assumption is primary trend cannot be manipulated. You can manipulate a stock or two or a sector. The last assumption is the current market price is a sum total of all greed, fear and aspirations of the market. And that is where we say it very simply, Bhav Bhagwan che. So the three major important data points for a technical analyst is price, volume and time. Now, prices are available on a closing basis, open, high, low, close. They're also available on an intraday basis today. Volumes is something which is peculiar in terms of India, because India is a very concentrated market wherein promoters own 50 to 70%, institutions own another 10-15% in a lot of companies. So volumes becomes a very important part in India, which may not be the case in a lot of global markets. Now, time is something very similar. What is your time frame? Say for an investor or a trader, the time frames are different. Even for trader, somebody could be trading at a one-day time frame, somebody could be trading at a weekly time frame. The advantages and disadvantages of technical analysis. So using technical analysis, you understand trends and you try to play them. But a major disadvantage is there will be false signals, there will be false breakouts. Your interpretation could be on a very smaller time frame. But the fact is, this is also another tool which will not be exactly right. So to conclude, technical analysis is essentially a study of demand, supply and sentiments. See you in the next video.